Welcome to Growth Investing Mastery. This video will look at the best growth stocks for 2026. As a reminder, this is not investment advice or recommendations to buy stocks. The purpose of this video is to find the best growth stocks heading into 2026. We are looking for accelerating financials combined with a compelling narrative. This channel places a big emphasis on getting results. And as of October 31st, the portfolio was up 152% year to date and up 520% since the start of 2024. Getting into our allocations for the month. We have three high confidence positions. The first is Iren with symbol Iren at 17.5%. Next we have AppLovin with symbol App at 17.1%, and Astera Labs, ALAB, at 16.5%. Then we have two positions which are right around 10%, Electrovaya with symbol ELVA at 10.4%, Hive Digital Technologies, Hive at 9%. That's followed by our four medium confidence positions. We have Biosciences, BHST at 6.2%, Health and Tech, HIT at 5.1%, Applied Optoelectronics, AAOI at 4.9%, and DUOT Technology, DUOT at 4.1%. There's two low confidence positions as well, Reddit, RDDT at 2.6%, and Dave Inc., Dave at 1.8%. Next, we have four microcap ventures, and for these stocks, for buying, we followed our same normal process, but we follow them a little less until they report their earnings. And the first microcap venture is Niagen Biosciences with symbol NAGE at 2.3%, Nephros NEPH at 1%, Organigram OGI at 0.9%, and Zoom Technologies, ZOMD.V at 0.5%. Taking a look at our results, in 2024 we were up 146%, and in 2025 we're up 152% year to date. The cumulative return since the start of 2024 is up 520%. And you can really see the power of compounding now when you stack those strong results on top of each other. I also stopped putting how the NASDAQ is doing on this page. On this channel, we believe beating the market is a very low bar to set, and we're confident our strategy well outperforms the NASDAQ over the long term. As for the results themselves, you can see how bumpy October was. We had a huge spike up, a big spike down, and then it went up about halfway to where it was before. You can also see earlier in the graph how big the downswing was in March and April, but also how fast the recovery was. Jumping into the individual companies now. Our first company is Iren with symbol IREN. The company is in the neo cloud space, and they're powered by efficient renewable energy. Recently, the company raised $979 million from an oversubscribed capital raise. The underwriters for this capital raise were Citigroup and Goldman Sachs, and it seems like they got pretty good terms here. Iren had originally planned to use their own capital through Bitcoin mining to finance their expansion. However, competitors such as Nebius raised 3 times the amount, or $3 billion, worth of capital with good terms. So it's likely that management saw an opportunity to scale up faster than expected. And the company is no longer providing monthly Bitcoin and HPC updates. This is because they reached their 50 exahash mining capacity goal on Bitcoin. And it didn't really make sense to keep pre-reporting stats every month because there would be not much to talk about on the earnings report. This upcoming earnings is likely to center around the HPC revenue and potential hyperscaler contracts. Iren's earnings date is coming up soon on Thursday, November 6th. Our next company is AppLovin with symbol App, and they're an ad tech product with a superior return on ad spend. The company's Axon Ads Manager launched on October 1st. This is a self-service system that is available on a referral-only basis to start off. And the company is still restricting their own growth while they scale up the self-service. The stock price has been pretty volatile as short sellers are still attempting to target AppLovin. It was recently reported that there was a whistleblower to the SEC regarding AppLovin. However, the claim was that AppLovin violated App Store and Play Store regulations. But this is not an issue that would get handled by the SEC, so the claim really makes no sense here. Additionally, there was no registered filing with the SEC about an investigation into AppLovin, so the story itself doesn't seem to hold water. It also seems it was admittedly the short sellers themselves who were the whistleblowers. There's two short reporting sites called Muddy Waters and Fuzzy Panda, which are producing the same AI slop about AppLovin. And it could easily just be one person running both accounts. I've heard a lot of people ask, why do these reports keep crashing the stock every time if it's obviously bogus? It's likely these short reports found a way to get their stories to land in the Bloomberg terminal. And there's a lot of institutional button clickers with a big trade mentality. But these institutional traders are not trading their own balances, and they can move huge amounts of volume. We saw the same thing on the last earnings call where the institutions sold off AppLovin heavily because they didn't understand that AppLovin had sold off their gaming business. Their earnings for AppLovin is on Wednesday, November 5th, and we expect a big result. Getting into another high-confidence stock, we have the company Astera Labs with symbol ALAB. Their product is AI Infrastructure 2.0, and recently the stock has been trading down on NVIDIA and Broadcom announcements. The market seems to have trouble placing or understanding where Astera Labs lives in the AI ecosystem. However, this company is innovating at an unprecedented pace in hardware engineering. I've personally never seen a company moving this fast on product announcements, and it's hard to keep up. The technology is changing fast, and they're signing significant partnerships within the industry. There's 3 recent news stories on Astera's investor relations page, which show the pace of the innovation. The first one was that Astera Labs was at the 2025 OCP conference, and they talked about a number of collaborations. Some of the bigger names mentioned were AMD, ARM, Amphenol, Wistron, and Synopsys. In this story, management mentioned there's 3 goals for AI Infrastructure 2.0: to collaborate, standardize, and accelerate. The second news story was that Astera joined the ARM Total Design and Comprehensive Ecosystem for the ARM Neoverse. I don't know too much about what the ARM Neoverse is, but this is an encouraging sign that Astera is collaborating more with a company as large as ARM. This collaboration enables chiplet solutions, which accelerates the time to market. I learned recently that a chiplet is like a mini chip. It doesn't require a full wafer to produce the chip. The chiplet collaboration with ARM leads into the third story. Astera acquired a small company called AI Xscale Photonics, which is scaling up for photonic chiplets. This company they acquired does optical I/O precision glass coupler technology. I put that phrase in quotes because I have no idea what that technology is. And this is where I mean the pace of innovation is so fast. I don't really understand chiplets or photonics too well, but we're still fine to invest here. And this AI Xscale Photonics was a small German company with just 20 people. The terms were undisclosed, but it probably wasn't that costly. Astera will likely give some more details on their earnings call, which is coming up soon on Tuesday, November 4th. Getting into our medium confidence positions. First up is Electrovaya with symbol ELVA. Their product is innovative lithium-ion batteries, and they had a pre-announcement of some earnings metrics. The management team said they'll have revenue of at least $20 million, which would be 72% year-over-year growth rate. However, no profitability metrics were given for the quarter, but we're expecting to see quarter-over-quarter increases in the profitability as they scale up. The press release mentioned the revenue is mostly from the materials handling sector, which was expected. They mentioned there was deliveries to a major construction vehicle OEM in Japan during the quarter. Additionally, they mentioned multiple robotic application customers were shipped to in the quarter. It's good to see sales in the nascent field of robotics for Electrovaya. And the next immediate markets seem like they're going to be defense, construction vehicles, and robotics. My take is the company likely pre-announced results to reassure the market. The company's earnings will be sometime in early December, which is after the time that most companies have reported. It's also very possible that the stock rallies significantly, reporting the same revenue number that they just pre-reported. I have seen this a number of times recently where a company pre-reported a strong revenue number, and the market just shrugged. But when the company actually reported their earnings with the same revenue number they pre-reported, the stock rallied significantly. Our next medium confidence position is Hive Digital Technologies, with symbol Hive. The company is a Bitcoin miner and high-performance compute provider. They recently reached 22 exahash of Bitcoin mining capacity as of October 27th. Tier 1 is the lowest level of data center redundancy, and they need to switch to Tier 3 so that they have better redundancy and backup. But for Bitcoin mining, they can use Tier 1. And the company's Bitcoin mining operation is expanding in Paraguay. They recently opened their third 100 megawatt green facility down in Paraguay. Within the last update that the company gave, they are producing 9.5 Bitcoin per day. And if we do some simple math to see the quarterly run rate for 90 days, that would produce 855 Bitcoin, worth 101 million. But this is keeping in mind that the last quarter revenue was only $46 million. And analysts are projecting $81 million of revenue for next quarter, which would be up a stunning 256% year over year and 77% quarter over quarter. These are the type of results that are likely to impress the market. There was a story this month on British Columbia banning additional Bitcoin mining. But after looking into this story, it does not seem to have a big impact. The reason for this is the original ban actually goes back to 2022, and the ban's just made permanent now. The mining that Hive does in British Columbia is grandfathered in. Although there was one small negative announcement in that government policy. The high-performance compute expansions from all companies will see additional scrutiny. But keeping in mind, this is a policy for British Columbia only, not all of Canada. And the Canadian government in BC wants to see the sought-after hydroelectric go to other sectors such as oil and gas. On the other hand, Toronto is open for sovereign AI and additional expansions. And it seems like the government for the Toronto region is really excited about AI and Bitcoin mining. Our next company is BioHarvest Sciences with symbol BHST, and their product is industrial grade plant exosomes. The underlying compound they produce is being integrated in pharmaceuticals and cosmetics, among other products. The company recently raised $11 million for building new capacity, refinancing debt, and adding working capital. The company recently announced a new CDMO partnership or manufacturing partnership to build a compound from synthetic saffron. And saffron is the world's most expensive spice, as they detailed, retailing for $10,000 per kilogram. They said each kilogram of saffron requires 150,000 crocus flowers to be collected by hand. Currently, 80% of this production happens in Iran, but there's also some in Spain and Kashmir. The company also did something which was a bit strange. They pre-released earnings in the saffron deal press release. They said they're expecting revenue of $9.1 million, which would be up 40% year over year, and adjusted EBITDA from negative 0.7 to negative 0.4. Adjusted EBITDA was negative 1.3 in the last quarter, so we should be seeing some step up in profitability, which is good. But they did give a Q4 guide of 9 to 9.5 million with adjusted EBITDA of negative 0.6 to 0. And that is a bit of a concern. There's not much sequential growth projected there. I did trim my position some because of how they announced these financials. A couple more details that the company added is their Venia Blood Flow Hydration Drink launches on November 7th. And Phase 2 of the Affiliate Health Pros program launches in November as well. So I'm hoping that that drink can drive some revenue in Q4, but we'll see what they say on their earnings call about that. I'm still really excited by this narrative, but we do want to be conscious this is becoming more of what we call a story stock. And I do think this technology has the potential to be a big game changer, but we'll want to see some decent numbers backing up that story. Taking a look at a medium confidence position, we have Health and Tech with symbol HIT. They are a B2B health insurance provider. Recently, the company announced a collaboration with AlphaTon, and that's to develop the HIT chain, which is built on the TON network. It's a blockchain solution that is immutable, transparent, and an efficient claims ecosystem. This blockchain solution will reduce administrative costs, which improves trust. The company also has an enhanced eDIBS platform, and that acronym stands for Do It Yourself Benefit System for brokers. It was upgraded in September 2025 to support 150 plus employee companies better. With this enhanced system, brokers can design their own underwriting guidelines, network discounts, and plan designs. Additionally, brokers can now generate up to 12 firm proposals from the platform. This new process is much more efficient than older technologies, and the company should be announcing the earnings date soon, sometime in November, so we'll stay tuned for that. Another recently started position is Applied Optoelectronics with symbol AAOI. They make optical electronic products for communication, and they serve the data center markets and cable TV. The stock price has been on a nice run-up since we first purchased. On October 28th, the company had a press release announcing the onshoring of part of their production to Texas. This addition of a new manufacturing line will add 210,000 new square feet, and they expect the first part of the facility to be operational by summer of 2026. The facility will require $150 million of CapEx over 5 years, and they expect to hire 500 employees for this facility. Completion of the facility will make it the largest production capacity for AI optical transceivers in the entire US. Looking ahead to the upcoming earnings, analysts expect $120 million of revenue next quarter, and that's stepping up from the previous quarter, which was $103 million. Analysts are also expecting improved profitability as the company is getting closer to GAAP break-even. Applied Optoelectronics will report earnings on Thursday, November 6th, and we're interested to see where they land. Our next company is DUOT Technologies with symbol DUOT. Their product is modular data centers, which fit into what's basically a shipping container. I listened to a recent investor conference with this company called the LD Micro Main Event, and I found that through the Quarter app. This conference boosted my confidence in the company significantly. I learned the company recently got a patent for their clean room that removes dust. The company's modular data centers support Tier 3 and Tier 4 data centers. The Tier 3 and Tier 4 are the highest levels of data centers, meaning they have the highest levels of redundancy and backups. Additionally, their data centers meet SOC 2 compliance and regulations. DUOT is partnering with education and healthcare institutions who need fast AI compute. Their first data center was in Amarillo, Texas, behind a school. The company is supporting the school with one of the 15 cabinets that the school bought. With the modular data centers close to the location, there's better connectivity and caches at the local level. Management said the modular data center acts as the mothership for all the schools. Once the data center is installed, carriers such as Verizon then want to join, and this increases the network strength. Management added, once carriers come in, you own that market, and they called their data center the Carrier Hotel. The goal is to get into markets and then start selling the carriers in. The sector is really telecom, management said, and everyone will have to cross-connect to DUOT to get robust networks. I was really surprised to learn that a cattle rancher actually bought one of the cabinets. They said this rancher has over 30,000 cattle, and they're watching them with drones, but they need to cache the local data. The rancher could not keep sending data back to Houston or Dallas easily, as it took too long and cost too much. One interesting thing about DUOT is they said we don't have competition, but there should be and there will be soon. I also really like this last detail. Management said they're cutting SG&A and other expenses. They're a higher margin business now, and we will look very different in 2026. Our next company is Reddit with symbol RDDT, and they do community-based social media. The company announced earnings on October 30th, and we were pretty pleased where the headline numbers landed. Q3 revenue was guided from 535 to 545 million, and the actual that they got was 585 million. Adjusted EBITDA for Q3 was guided from 185 to 195 million, and they actually got 236 million, a very significant beat on profitability. The new revenue guidance that Reddit gave for Q4 was for revenue of 655 to 665 million, and that's versus 428 million last year. Adjusted EBITDA in Q4 was guided from 275 to 285 million. Something important to keep in mind is that Q4 is the strongest season for Reddit, as they see a lot of seasonality from the holiday season. One financial that really impressed me was the GAAP net income trend. Over the last 5 quarters, GAAP net income has gone from 30 million to 71 to 26 to 89 and then to 163 in the latest quarter. So we've had this really huge step up in profitability recently, which is really nice. But there were some other interesting stats from the slide deck that they released, which gave me a bit of pause on increasing my position. They showed that U.S. revenue made up 480 million and international was 105 million. So this means a huge majority of their revenue is coming from the U.S. That's not such a huge concern on its own, but when you combine it with these other statistics, I did get a bit concerned. Logged in U.S. users grew 7% year over year, but logged out international users grew 42% year over year. And those logged in US users are the most valuable ones they have, while logged out international users aren't worth as much. So the users that are really profitable for Reddit are only growing 7% year over year. Additionally, weekly active unique users in the US grew 6% year over year, while weekly active unique users internationally grew 37% year over year. The company did see significant ARPU growth as it got up to $5.04 per user, and they did say this is low on an absolute basis and remains an opportunity. Management also added there was a tailwind for pricing in the quarter, and they said their ad load is much lower than their peers. So Reddit does actually have a lot of room to juice the US users quite a bit more, I think. But at some point that well may run dry if their user growth in the US is not growing significantly. The end result is that I'm holding my existing position. They had great financials and delivery, but some of those metrics look a little bit low. One of our low confidence positions is Dave Inc. with symbol Dave, and their product is an alternative bank for membership-based banking. This company used to be a bit higher allocation, but recently the low 14% customer growth has me concerned, and that's combined with 64% revenue growth. And normally I don't like to compare too heavily to another company for drawing conclusions. I'm a big believer in the uniqueness of every market opportunity. But there is a possibility the situation here is similar to Sezzle, where they are one quarter behind. Both of these companies benefited from renegotiating the fee structure of their platform. And during the month, I kept finding other promising companies and was trimming Dave to raise funds for those. The stock did rally from $200 since we trimmed them heavily. And this often happens. We may have poor timing on pricing for the stocks we own. That's the key point, that our strategy does not depend on getting good prices or timing. And sometimes we'll just hit variance where we trim heavily and the stock goes up right after. But we're still interested to see what Dave reports. And their earnings is on Thursday, November 4th in the pre-market with an 8 a.m. call. One new stock we bought this month is called Niagen Biosciences with symbol NAGE. Their product is a supplement that targets healthy aging and cellular metabolism. The history of this company is that they rebranded from the name Chromadex in March of 2025, but the IPO dates back some years before. Revenue in the latest quarter was $31 million, which is up 37% year over year. And the company had EBITDA of $3.4 million and net income of $3.6 million. It's good to see the company is already profitable as they're scaling up. The market cap is $580 million with a gross margin of 65% and a very healthy balance sheet of $60.5 million of cash and no debt. True Niagen makes up 73% of sales, and that's their consumer product. That product is up 22% year over year. But what's really got me interested is the Niagen pharma grade ingredient sales are $7.4 million, and that's up 135% year over year. One direct quote from management was they anticipate growth in Niagen ingredient and broader B2B sales. There's currently over 800 wellness clinics nationwide that offer Niagen. Management said the buzz around Niagen is strong and growing. Additionally, Niagen has been featured in a lot of media. The company is going through the proper channels with the FDA and the FTC to make sure they're properly regulated. And the company was able to raise their guidance a small amount last quarter, with full year revenue previously projected from 20 to 25%, now going up to 22 to 27%. It's not a huge guidance raise, so we're not that excited about it, but it's good to see they're able to raise guidance some. Management mentioned that people who do Niagen IV at clinics sometimes have a 1 to 2 day skin glow. They added, "We're going to investigate that further." And the glow seems to correlate to a meaningful impact on how people feel and how they look after. Additionally, management mentioned there appears to be treatment for long-term COVID symptoms from Niagen. It sounds like they're investigating that use case for long-term COVID symptoms as well. The earnings for this company is on Tuesday, November 4th, so we'll see what they report then. And I'd be curious if any listeners out there have ever heard of Niagen or used it before and what your experiences are. Another new position this month is a company called Nephros with symbol NEPH. Their product is water filtration solutions for medical and commercial. And they recently released their Series 19 filter, which addresses PFAS, or forever chemicals. Their filters offer a much broader spectrum of contaminants contained, and they use a technology called hollow fiber technology. Some of their top customers include healthcare institutions, daycares, and schools. Revenue in the latest quarter was $4.4 million, which was up 36% year over year. They had EBITDA of $0.3 million and net income of $0.2 million. So the company just crossed into the threshold of profitability. The market cap for this company is quite small at $60 million. They have a gross margin of 63%. And the balance sheet is pretty healthy. They have cash of $5.1 million, debt of $1.2 million. And it's a pretty small company overall. It's 31 employees. The stock price is down 99.5% since its IPO in 2004. I'm not sure why it was so much higher back then or why it was so hyped back then, but it could be a thread worth pulling on as we investigate more. Some encouraging parts of the narrative are they said programmatic sales reached an all-time high. And they added, this shows the efficacy of the recurring revenue model. There's a thriving installation program and accelerated reorder rates. The company is also expanding its sales force and doing more social media marketing. Revenue for this company can be sometimes lumpy due to emergency orders from customers. And they detailed a situation where this happened. It was a healthcare facility that had a water infection, and they desperately needed a lot of filters right away. The filters themselves are approved by the FDA as medical products, and filter prices range from $60 to $300. However, the full-scale system that they sell to places like hospitals costs much more. Nephros reports earnings on Thursday, November 6th in the pre-market for their press release, but they do the call after the market closes. One of our low confidence positions is Organigram with symbol OGI. Their product is cannabis and they're based out of Canada. Recently, I just realized the company's CEO position is open. They're actively looking to make a hire, as they mentioned on their press release. However, I thought they had a successor already planned based off what they said, but the current CEO is staying on till November 30th to help this transition. They said in the press release that the search is yielding promising results, but they haven't made a hire yet. I was looking up some history about the current CEO, and they tripled revenue during the last 5 years. So it is a little bit of a curious departure, but the CEO did say it's for their retirement. This whole situation leaves a lot of open questions, and I took some action to reduce my position. However, I still expect a stronger quarter than the analysts expect. Another big question mark is how the acquisition is integrating. On the previous quarter, they had a mix-up with an ERP system, and that hurt revenue in the prior quarter. They made a big fuss about it on the last earnings call, but they did say they got back on track, and that's part of the reason I think this company is going to beat analyst estimates significantly. Our last company is ZOMD Technologies with symbol ZOMD.V. This company trades on the Venture Exchange in Canada. Their product is a mobile-first digital advertising and marketing platform. They offer campaign optimizations, real-time analytics, and advanced user acquisition. Recently, the company announced there's a new partnership with a company called E2 in sports and the betting industry. The two companies were already collaborating via a proof of concept, though. But now they're formalizing this partnership so E2 can offer Zoom services to its clients. E2 has deep sportsbook expertise, and Zoom already has a partnership or customer with Fanatics, who does sporting merchandise and has a sportsbook. The earnings for Zoom are in late November, so we'll see what they report. Let's now take a look at the one company we sold this month, which was CPS Technologies, with symbol CPSH. The company makes metal composites and ceramics for semiconductors and defense. They just reported earnings on October 30th. There were a number of items from the earnings report that we actually really liked. The first was that revenue came in at $8.8 million, and that was versus $4.2 million last year. This makes it 110% year-over-year growth and 9% quarter-over-quarter growth. Gross profit in the quarter was $1.5 million versus negative $0.5 million last year, an impressive acceleration. Additionally, net income was $0.2 million versus negative $1 million last year, so the company became profitable recently. Management said there's increased customer demand and greater shipping volumes. Additionally, management detailed that they landed their 5th and 6th federally funded research contracts that are signed with the government. So why did we sell if the numbers look this impressive and the story sounds pretty good? Our biggest concern is management said they're unlikely to achieve another record quarter, and this is implying a sequential revenue decline. They did say that Q4 is historically a slower quarter, but I went back and checked from Q3 to Q4 last year, and revenue went from $4.2 million to $5.9. So revenue did increase sequentially from Q3 to Q4 last year. Management did say they're not seeing a big impact from tariffs yet, although they did add the near-term outlook remains uncertain due to the government shutdown. They did mention they have gotten paid since the government shut down, but they almost sounded surprised they're still getting paid for their contracts in the shutdown. Another concern I have is that they're moving to a facility that's 2 times in size to increase their production capacity. My understanding is they will not keep their current facility. They added this size increase will satisfy demand for the foreseeable future though. But it left me wondering if a 2x increase is enough space for the foreseeable future. And the company did recently raise about $10 million for this new build-out. To quote management, they said the move is disruptive. They also described something they called a leapfrogging situation in 2026 as they move over to the new location. The idea here is that some of the machines at the old location will be kept running as they move the machines over to the new place. And even though we did sell this company, we're still interested to keep an eye on this company as it sounds promising still. Now let's get into some promising new ideas that we discovered this month. The first is called Silicon Laboratories with symbol SLAB, and they make wireless connectivity products for IoT, smart homes, and industrial use cases. In the latest quarter, revenue was $193 million, which was up 33% year over year. However, the company is not profitable yet, with negative $13 million of EBITDA and negative $22 million of net income in the latest quarter. The company's full year guidance is projecting mid-20s year-over-year growth rate, and the next quarter's top end of the guidance is for 23% year-over-year growth rate in revenue. With this company having a market cap of $4.4 billion, it seems like we'd be paying a lot for a company that's unprofitable still at this scale. Another company we looked at this month was called Mind Technology, with symbol MIND, and they do advanced marine technology for seismic exploration, surveys, and defense. Revenue in the last quarter was $13.6 million, which was up 35% year over year, and the company is already profitable with just a tiny market cap of $88 million. In Q1 of this year, the company saw supply chain issues combined with customer logistics bottlenecks. My big concern with this company is they have some really strange backlog numbers that seem to drop off. And one of the analysts actually called out management on this and said they're really confused if there was reclassifications or cancellations. Because of this, we decided to add Mind to our watch list rather than start a position. But we'll take a look at their next earnings and see where they land. Another company we looked at this month was called AirSale Corporation, and Air is spelled AER there, with symbol ASLE. The company serves the aftermarket for aviation products, leasing, and resale. They also provide what they call tech ops, which includes maintenance, repairs, overhauls, upgrades, and mods. In the latest quarter, revenue was $107 million, which was up 39% year over year, with EBITDA of $17 million, net income of $8.6 million, and a market cap of $368 million. We held off starting a position because this is a bit more of a stodgy business than we typically look for, but it could be interesting if they continue to get strong results. Taking a look at some more promising ideas, we have Ava Point with symbol AVPT. They are a SaaS cloud data provider that secures, manages, and does backups. Additionally, they help with automation and optimizing data. The SaaS portion of their business made up 76% of revenue and was up 44% year over year, with the rest of the revenue coming from services and support. Total revenue was $102 million, which was up 31% year over year, and they had EBITDA of $8.7 million, net income of $2.7 million, and gross margin of 74%. So that's really promising. The company's already profitable at this scale. The market cap of $3.2 billion seems pretty reasonable, but I'm not sure there's enough here to get excited about. Their guidance for next quarter implied revenue of $108 million, which would be up 21% year over year, and that's a little bit lower than we're typically looking for. The next company we looked at is one we used to own. It's called Micron Technology with symbol MU, and they're a memory maker with competitive advantages. The company's HBM4 delivers the best performance and energy efficiency in the entire industry, and they're based out of the US. Net income in the latest quarter was $3.2 billion versus $887 million last year, and this shows the scale of the increased profitability. The stock has had a run-up to a $250 billion market cap, but I'm not sure there's enough immediate upside with this stock. Micron also overlaps with companies in my portfolio currently. There's other faster growing and smaller semiconductors that also benefit from the AI tailwinds. Let's now take a look at some promising international new ideas. The first is LUXE Experience with symbol LUXE. They're a European-based fashion retailer. In the latest quarter, revenue was $692 million, up 165% year over year, and that was driven by acquiring YNAP brands. Additionally, the company has an increased online presence. However, most of their growth is through acquisition. LUXE Experience has a strong balance sheet and profitability, despite the recent acquisitions. The company has a $1.24 billion market cap with cash of $711 million and debt of $258 million. I would like to see another quarter of results to confirm the growth and profitability. That's because the numbers may have gotten a bit skewed from the acquisition, and I want to see them continue the business momentum. The next company is Freightos Limited with symbol CRGO. They are an Israeli-based digital freight booking and payment platform. The company's latest quarter had $7.4 million of revenue, which was up 31% year over year. The financials show an impressive 71% gross margin, although they're still unprofitable. However, the market cap is pretty small at $176 million. The narrative or story that the company is telling sounds incredibly positive for digitizing shipping. And the company's revenue is derived from transaction fees and their SaaS platform. My biggest concern is their guidance implies only a small step up in revenue, and I would like to see them surpass this number significantly. The next promising international idea is NUI Technologies with symbol NIU. They are a Chinese-based motorbike and scooter manufacturer that is NASDAQ listed. I learned recently that both China and NASDAQ have increased regulations regarding IPOs and ADR dual listings. So normally we wouldn't even really look at too many Chinese companies, but we started taking a look now that the regulations have potentially improved. The company's guidance implies over 70% year-over-year revenue growth in Chinese sales, which make up a majority of their revenue. The company gave an encouraging mid-quarter update on their investor relations page. While the company did have increased Chinese sales, the international market is lowered from tariffs. But international was making up a small percentage of revenue anyways. And NUI has a low valuation even for a Chinese company. They have an implied $222 million revenue quarter based off their guidance. And cash is $171 million with debt of $31 million. And the market cap is just $352 million. I actually tried to buy a small starter position in this company. And when I tried to buy the stock on Schwab through the web interface, it wouldn't let me, and it said I needed to call in and talk to somebody. That was a bit strange, and when I called in, they said there's some unusual activity on the stock. What was frustrating was that the Schwab rep couldn't tell me what the unusual activity was, and they said some instances of unusual activity include higher volume and price volatility. However, a lot of the volatility and the price changes are coming from their announcements. But it was kind of a yellow flag or warning sign, and I decided to hold off and see how the earnings look and then reevaluate from there. Let's now wrap up with some final thoughts. We had high variance positive results in October as we saw big swings up and down. And we're continuing to prepare for the earnings season on the individual companies, as many companies report this week. We'll have earnings coverage on all of our companies that report in the next summary. Our next strategy video will be on valuation, and we'll use an analogy of selecting from a toolbox to explain valuation. This concludes the video, and let me know what you thought in the comments section of the stocks or any of the content. Feedback and questions are always welcome on this channel. And just as the last reminder, this is not investment advice or recommendations to buy stocks. Thank you.